In 2008, as the world was already grappling with the worst financial crisis since the Great Depression, another revelation shook the very foundation of trust in global finance: the LIBOR scandal. LIBOR, short for the London Interbank Offered Rate, was once considered the world's most important number. It was the benchmark interest rate at which banks lent to each other, and it influenced the cost of trillions of dollars worth of loans, mortgages, student debt, and financial contracts across the globe. From a homeowner in New York paying off a mortgage, to a student in London taking out a loan, to a corporation in Asia issuing bonds, LIBOR quietly touched almost everyone's financial life. Yet behind the scenes, some of the biggest banks in the world were manipulating it for profit. LIBOR was not calculated by actual trades, but by estimates submitted by a panel of major banks, who were asked daily, at what rate could you borrow funds? In theory, this was supposed to reflect the real cost of borrowing between banks. In practice, however, it created room for abuse. Traders within banks realized they could nudge the numbers up or down to benefit their trading positions. If a trader had a bet that would pay off if LIBOR was slightly lower, he could pressure the bank's submitters to quote a lower rate. If higher rates were more profitable that day, they would push them up. These tiny adjustments might have looked trivial, but when scaled to the vast size of contracts linked to LIBOR, they translated into billions in profits for banks and losses for ordinary people, pension funds, and companies worldwide. The scandal came to light when investigative journalists and regulators began to question unusual patterns. In 2012, Barclays was the first bank to settle with regulators, paying hefty fines and admitting that its employees had tried to manipulate LIBOR. Soon after, a wave of investigations swept across global finance, implicating major institutions like UBS, Deutsche Bank, and Royal Bank of Scotland. The fallout was enormous. Billions of dollars in fines were issued, careers were destroyed, and public trust in banking was shaken to the core. More than just a financial crime, the scandal highlighted how fragile and easily manipulated the plumbing of the global financial system really was. The consequences went beyond punishment. Regulators realized the system itself was flawed. LIBOR relied on trust, and that trust had been broken. As a result, global authorities decided to phase out LIBOR entirely, replacing it with more transparent and transaction-based benchmarks like SOFR in the US and SONIA in the UK. By the end of 2021, LIBOR was largely retired, marking the end of an era. The LIBOR scandal serves as a reminder of how a seemingly technical number can influence the everyday lives of millions, and how greed, when unchecked, can corrode the foundation of global markets. It underscored the need for accountability, transparency, and strong oversight in financial systems where even a fraction of a percentage point can shift the fortunes of nations and individuals alike.